bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 17th, 2024 podcast. Today's podcast is the second of a two-part series on the tax credit equity markets. As those of you watching YouTube can see, my guests are again my partners, Brad Elphick, Dirk Wallace, and Tony Grappone. Brad, Dirk, and Tony joined me in part one of this podcast to discuss the current state of the tax credit equity markets. In part one, we discussed ranges of equity pricing and some of the correlative effects. Now, by tax credit equity markets, we mean the markets for the low-income housing tax credit, the new markets tax credit, the historic tax credit, and more broadly, renewable and clean energy tax credits. If you missed part one, which we did post last week, I encourage you to go back and listen to it. Now, in today's podcast, we're going to move beyond the current status of percent equity pricing and focus on some of the future developments that could affect the supply and pricing of tax credit equity. And as I shared in the first part of this podcast series, please remember that what happens with one tax credit can affect the other tax credits. For example, the demand for or supply of one particular tax credit can and generally will have ripple effects on other tax credits. The most obvious recent example, which we did note in part one, was that the dramatic increase in clean energy tax credits, an increase that hasn't stopped, has affected the markets for the historic tax credit, the new markets tax credit, and low-income housing tax credit to different degrees, or it affected the three credits in different ways. Now, there are many future developments that could affect tax credit equity pricing. We're not going to cover all of them. One that we're not going to spend a lot of time on is the overall state of the economy. Clearly, if we headed into a recession, there'll be less demand for tax credits since there'll be less overall tax revenue. And then similarly, if we ended up in a rapid period of growth, there would, generally speaking, be a lot more taxes due, and generally speaking, more tax credits hitting the market. Now, in today's podcast, we are, though, going to focus on four major, what I'll call regulatory potential changes. One is the status of Community Reinvestment Act regulations. The second are bank capital rules, also referred to as Basel III. These are rules that affect the amount of capital a bank has to hold relative to the investments they make. The third area we're going to touch upon from a regulatory perspective, even though it has statutory aspects to it, is the global minimum tax that's in the process of being adopted worldwide. When that will ultimately be adopted remains to be seen, but there's certainly huge momentum towards enacting a global minimum tax, which is done on a country-by-country basis. And then fourth, we'll also touch base on book or GAAP accounting. So as I noted, these are generally regulatory matters with the global minimum tax having a statutory aspect to it. But we're also going to cover future tax law changes. And when we look at future tax law changes and the impact on these credits, we'll focus on both direct and indirect effects. When I say direct effects, I mean how each credit itself might be altered in ways that affect its demand among investors, as well as how the supply of each credit might change. And when I talk about indirect tax law changes or indirect effects of tax law changes, I'm thinking of something along the lines of a change in the corporate tax rate, for example, or the overall supply of investable tax credits. Now, Brad, Dirk, and Tony were on last week's podcast, and they're all familiar to our frequent listeners and viewers of this podcast. They're obviously experts on the areas that we're going to discuss today. So if you're ready, let's get started. So Brad, Dirk, and Tony, welcome back to Tax Credit Tuesday.
Great to be back.
It's been so long. It has. So we have a lot to discuss today for this episode. And I had you share in the first part of this podcast, the type of work you do for clients at Novogradac. So I would encourage our listeners or viewers to go back and watch the first episode, if for no other reason, to learn more about the services Brad, Dirk, and Tony could be providing to you and those you work with. I'm going to skip that now and jump right back into the discussion. And as I listed in the intro, there are a number of regulatory changes that are in process that I'd like to get your thoughts on, sort of how they affect the tax credit community within which much of your work is done. I'll try to do this in a somewhat rapid fire fashion. So I encourage you to be rapid fire too in your responses. And I'll start with Dirk, and I'll direct the initial question to Dirk in terms of how the Community Reinvestment Act regulations and some of the delays in implementing them is affecting the multi tax credit market. And that is certainly the tax equity market, the largest tax credit equity market that's most directly affected by the Community Reinvestment Act regulations. So Dirk, what do you want to share with our viewers on this matter?
Sure. So I'd just like to remind everyone that we did have a podcast back in November, so you can get your full CRA needs met listening to that podcast. But the CRA final regulations were passed back in October of 23. And really at a very high level, it changes the way in which banks would get credit in their CRA test for LIHTC investments. And when we look at those changes, historically, banks would look at where they take deposits and they would look at that geographic area. Well, now they are able to look outside that geographic area and pretty much across the country. And when you look at that and start to think about supply and demand and where investors are looking, and looking at the current CRA markets, I don't know, I'd go so far as to say that there would be less, downward pressure in those markets. There's still plenty of demand going to be there. But I think when you look outside of the historically larger CRA markets, there would be upward pressure in pricing. In some rural areas or areas that historically maybe didn't have as much demand, I think we can possibly start to see more demand in those areas with the final regulations. I will say that the final regulations, the earliest that a bank would adopt them is January 1st of 2026. And I know there's a lot kind of still playing out in the courts, so it's kind of a little bit of a wait and see. But from a LIHTC perspective, that's kind of the current landscape.
Great, thank you for that. I'd also add to your broad overview as to the impact of the CRA regulations that the regulations do move away from an investment test, a 25% investment test, towards a community development financing test. And there was initially concern when the initial proposed CRA regulations came out as to the movement away from the 25% investment test to this other community development financing test might lead there to be less interest in investing in LIHTC. The final regulations were a step better than the initially released proposed. And there is a bit of trepidation out in the local taxpayer community as to what impact the final regulations may have. I would say that general view that I hear, and I'd like to get your thoughts, Dirk, is that the final regulations aren't likely to have a dramatic negative effect on bank investing in LIHTC.
I would agree with that. Yeah, I haven't heard too much of a negative impact from the final regs.
So Brad, the other major community development tax credit that is per se CRA qualified is the new market tax credit. What's the outlook for new market tax credit investing in the adoption and taking effect of the final regulations, subject, of course, to the judicial challenges and the rest that are out there?
Yeah, I mean, I think it's very similar to what Dirk said for the low-income housing tax credit. It's very, most of the new market tax credit investors do have CRA requirements and invest to meet those CRA requirements. So depending on what, where the incentives are to get the CRA credit for their investments, that's typically where you're going to see many of those investors trying to fill up their investments in. in terms of where they put those investments. There are some that aren't CRA driven in the new market tax credit equity market. So those aren't impacted by these changes, but predominantly most of them are. And so, with there being little changes in terms of, the impact and really kind of the way that investors are reacting to these changes as of right now, we haven't really seen a change yet. A lot of times in the equity market, you'll start to see investors really kind of getting ahead of the change before it actually happens. I think we're too far from that period of time really to see anything now. As Dirk said, kind of the first round or the initial changes may not be, for another 15 months or so. So I think it's still too early to tell exactly kind of what impact it will have. And, the measurement period that investors cycle through also has an impact of when that will change as well. So, I mean, we could be years away from seeing some investors impacted by any of this. And I think that while CRA definitely is a big incentive for new market tax credit investors, it's not the one that's going to have the most impact over the next 12 months or so.
I appreciate your pointing out that equity markets can anticipate
Right.
changes. I think you all know where I'm going to go. Many of our listeners or viewers might know where I'm going to go too. We best saw an example of that when Trump was elected to office, and there was an expectation that the corporate tax rate was going to drop from 35% down to 28 or 25, ultimately got to 21, even though he was even talking about 20 or 15%. And the equity market anticipated that, in the area, the tax rate most affected by the corporate rate was long-term tax credits. And since you claim those over a 10 plus year period, investors were basically looking at long-term tax rate investments and saying, we think there's a good chance the corporate tax rate is going to be dropped. As a consequence, the value of the tax losses will be less. And they started pricing that in. And that was initially, when you think of like any of these issues we're talking about, we need to be thinking about how the equity markets might anticipate those changes and how those changes might affect these various incentives and when the timing of investments. And as you noted, banks right now are still under the old regulations. So when you think about, something not taking effect till 2026, you'd think, well, since they're under the old regulations, the old evaluations, you wouldn't expect it to have an effect until 2026 at the earliest. However, you might think of, well, maybe I'll invest in ways that look good under both. You might see a little bit of anticipatory investing, but I would also note that even the 2026 deadline, it's unclear if all banks would be affected as of 2026, or would have to do with when their 3-year cycle of review comes up. So there is a lot of, there's a lot that's unknown, even beyond the corporate or even beyond the judicial challenges of the regulations. There's a lot unknown about implementation. So it's one of those examples that we'll have to wait and see and continue to be cautious and attentive to what developments might come. So Tony, when we think of CRA, go ahead.
I was just going to add one more thing about new market tax credits and CRA. I mentioned on the previous podcast, we've been talking to investors about, what impact all of these different changes may have in the equity market. And as we've talked about before, new market tax credits is about to embark on a $10 billion allocation round. And it's interesting, start thinking about the amount of allocation that will be awarded in, a year plus, and how that might line up with some investors' CRA measurement period. It can have a tremendous impact in terms of their appetite for that $10 billion. So, one more thing to kind of to consider when you're looking at CRA and the timing of it and lining up with different factors like a $10 billion round.
I would just note to remind the listeners, when we talk about a $10 billion round, we're talking about $10 billion of equity issuance. So that's right. 3.9 billion, 39% of credits, which is double what's been allocated in sort of prior rounds. So obviously double, going from, just under 2 billion to 4 billion is a lot. When you look at the broader equity markets, and there's 25 billion of long-living tax credits and north of 20 billion of renewables and the rest, it doesn't look as large in percentage terms. But Tony, when we think of Community Reinvestment Act, we think about longevity tax credits. We think about new market tax credits. We don't really think about historic tax credits unless it's connected with new markets and or longevity tax credits or otherwise is CRA eligible. What impacts are you seeing with the regulations on the energy markets?
Yeah, not as much. Renewable energy investments have never automatically qualified for CRA. In order for them to qualify, they've got to be in certain areas or meet other criteria, and so they don't automatically qualify like they do in in the low-income housing credit program or the new market tax credit program. And so, I'm sure the renewable energy industry would love that if they could sort of get that same favorable treatment that you can find in LIHTC as well as new markets, but it's just not the case. I know, the industry advocates have tried to lobby for that to get to change the CRA regulations so that renewables can automatically qualify, but it's just not the case. And as a result, the industry's had to try to win over investors and bring them into the market, despite the fact that those investments generally don't qualify for CRA.
So Community Reinvestment Act, as we've been discussing, it affects banks and their Community Reinvestment Act obligations under federal banking regulations. Another area where banks are notably impacted by government regulation is their bank capital requirements. And the banking regulatory agencies in the process of updating their bank capital charges. And as a general matter, the greater the charge against the given investment amount that you have to hold back in capital to ensure, safety and soundness of institutions. If you have to hold more capital against a given investment, then your yield for that investment has to be slightly higher to cover the cost of capital. And as part of the initial proposed changes, longevity tax credits, new market tax credit equity, the amount of capital you'd have to hold was going to be held the same as under the prior rules. But renewable energy would have fallen into a category where the capital holdback charges were going to go up dramatically from 100% to 400%. Now, our various working groups, the new market tax credit working group, longevity tax credit working group, had asked for, new markets and LIHTC to actually be lower the capital charges because they're more bond-like in terms of their returns and the rest and their risk profile. Also asked that renewables not be subject to that higher requirement. But Tony, we'll start with you, since that would be such an adverse effect on renewables. Describe the reaction of the renewables community and what some of their expectations are as this regulatory process continues on bank capital.
Yeah. Okay, great. Thanks, Mike. So, yeah, most of the tax equity investment dollars in the renewable energy space come from large household family name banks. Now, under the current proposed Basel III regulations, they would do, as you kind of alluded to, the Basel III global banking standards would require banks to essentially hold $4 in reserves for every $1 of tax equity investment that they made into a clean energy tax equity investment, compared to $1 under current rules. Okay. And so that's because large household family name banks tend to invest the most of the dollars in the renewable energy space, this has had a significant impact on that investor base group, especially for production tax credits. PTCs, that's a 10-year tax credit stream. And so as banks think about their Basel III requirements and they kind of look out over that long-term horizon, really these proposed regulations have pretty much put a stop to these certain banks writing term sheets for PTC transactions. And so now I think there are many in the tax credit investor community that operate in the renewable energy space that are somewhat cautiously optimistic that when the final regulations get released, which I think we're hoping for soon in 2024, that there will be some sort of fix to what was in the proposed regulations. And they're hoping that increased capital weighting charge that was in the proposed regs is reduced to something either down to 100%, which is what they currently are, or maybe somewhere at least lower than the 400% level that's in the proposed regs.
I like the way that you broke out production tax credits versus ITC, because it's good example of how investors are anticipating regulatory changes and the implementation schedule for those changes. Because in essence,
right.
ITC changes, in all likelihood, even if the requirements go up, they'll be phased in a framework such that those investments will be recovered before the higher standards kick in, whereas a 10-year production tax credit would carry into those higher ones. So it shows you the anticipatory nature of investing. So Dirk, let's turn to you and the ultimate tax credit and what impact these discussions of the Basel III changes are having.
I would say right now it looks pretty good compared to Tony's renewable energy tax credit.
We can't have it all.
Right. So we right now there really isn't a significant impact, on the LIHTC markets. And as you mentioned, the low-income housing tax credit, the LIHTC working group did submit a comment letter asking that it should even be lower than 100%. And if that were to happen, I think it would look even better and could lead to some upward pressure on pricing. But yeah, right now it's kind of just status quo, and there were really no impact on the current market.
Brad, new markets, historics.
Yeah, I mean, it's the same story as low-income housing tax credit. I think there's a reasonable argument that 100% is too high too. And so when you look at the risk related to these types of investments and the amount of recapture that we've seen, new markets has had no recapture that we're aware of. That's you would think it would get a pretty good risk based weight rating. And so I think that, there's not a whole lot of changes in kind of how the investor market's reacting to this right now.
I would note that this is an example how the effects of regulations on other tax credits end up affecting the relative attractiveness of other tax credits. So as, to the extent that renewables end up with a much higher weighting, then that makes comparatively the other taxes that don't have the higher weighting more attractive from a risk capital perspective. I also would note more broadly, beyond just the tax credit community, to the extent that overall risk weighting on other assets are on average rising. Once again, if everything else is rising in terms of the risk capital weightings and you're staying the same, comparatively, you're looking a lot more attractive. So it seems like, broadly speaking, it would have the effects are going to be comparative attractiveness, attractive to LIHTC and new markets. That being said, as you have higher capital, there's just overall less investing. So that's why I like it when you mention pressure. As Dirk knows, I'm always about the pressure different effects will have on equity pricing, because there's other effects that have countervailing pressures. So it's hard to know exactly what will happen in terms of overall equity pricing. So let's move beyond the banking institution, just more broadly, large corporate investors. Corporate investor market dominates investable tax credits in large measure because of the passive activity rules that limit individual involvement. And on the one tax credit where those rules don't limit involvement, the alternative minimum tax limits involvement. So generally speaking, we have a corporate dominated market, and the corporations that are international in terms of their operations, they're closely watching the potential for a global minimum tax to be implemented. And a global minimum tax has the potential effect of reducing some of the benefits of US-based tax credit investing. So Brad, you're the Novogradac in-house expert on the global minimum tax. So briefly, if you could just share the global minimum tax and how it could have a negative effect and what impact it's having today on the equity markets.
Yeah. So, and I think, we're all involved in these tax incentives. Tax incentives are meant to reduce your tax liability. And so anytime you hear minimum tax, I think all of our, antennas go off because it's like, wait a minute, how is this going to impact the value of these different tax incentives? And so I think generally anytime there is a minimum tax of any kind, our first question is, yeah, but are our tax incentives that we're, concerned about excluded from that calculation in terms of how you get to that minimum tax? And so when, this notion of a global minimum tax discussion has been going on for a while now. And, we've had different conversations about it, and we can talk about, whether or not it will ultimately pass or be adopted. But ultimately, I think that, the concern is how are these investments going to be treated when calculating this effective tax rate, this minimum tax rate. And with the tax credits and this global minimum tax specifically, it was very favorable to refundable credits in terms of being excluded from that calculation, in terms of reducing the effective tax rate. However, it didn't really specifically uh, uh, describe or exclude the type of tax credits like the low income housing tax credit, new markets, historic, renewables that are not refundable tax credits. And so there was a lot of concern in that initial drafting of the rules and the initial release of those rules in this favor for refundable credits, which really isn't how we do tax incentives in the United States. And so there was a lot of push from the different industries, our different working group, to make sure that there was, a discussion, a seat at the table for tax credits like LIHTC, new markets, historics, and so forth. And fortunately, in some subsequent guidance, they made it clear that investments in such tax credits that are not consolidated but accounted for using the equity method of accounting would not affect the calculation in a negative way. And so, in a lot of ways, that was a big relief for those corporate investors that you were mentioning that may be subject to a minimum tax if it's ever implemented. However, I will note that there is one issue in that language that is relevant to new market tax credit investors, and that it says that are not, the language said for investments that are not consolidated. Most new market tax credit investments are consolidated. So it's potential that the potential that those types of investments would still be, have a reduction in value as it relates to investors who may be subject to this 15% minimum tax. So there's still work to be done as it relates to the global minimum tax. I think that any additional clarification that is specific to our tax credits would be helpful, because I think there's also concern that uh, while we may be optimistic that this is a nice resolution using the equity method of accounting, there's always the concern of how will other countries interpret this guidance, and that there may be some countries who don't deal with tax credits like we do that may not interpret it the same way, and so that there could be concerns about how that would be implemented. And so the global minimum tax has this, all of these questions I think associated with it, especially when you think about how all the different countries are adopting their own legislation to be ready if it is adopted. So I think it's something that we as a tax equity incentive market will be definitely interested in, especially for those clients who are would be caught up in the global minimum tax. So I don't think that we're necessarily out of the woods or safe yet. There has been some favorable movement, but still work to be done as it relates to global minimum tax.
I really appreciate you focusing on the fact that ultimately, every country has to adopt their own legislation to be global minimum tax compliant, if you will. And while we can get this international guidance as to how certain tax credits are treated for the calculation, you're always a bit concerned how any one individual country will interpret it, and to what extent they might interpret it in ways that reduce some of the benefits, the net benefits to investors in U.S. based investable tax credits.
Especially how it may change the market in terms of those investors will shift dollars from investable tax credits to any refundable tax credits that we have currently.
And I would also note to our audience that when this issue first arose, it was really the long-dated tax credit investors and the renewable energy tax credit investors that were most concerned about this. And that's just because of the sheer magnitude of those communities and dollars invested. When you think of the long-dated tax credit being 25 billion plus a year of investable credits, plus or minus, and renewables being north of 20 billion, there are major institutions that invest enough in these areas that it could have a notable impact on their effective tax rate and kind of bring them down below the 15%, which is the global minimum tax target. Whereas when you think about historics or new markets, there aren't investors with a big enough portfolio that they're notably reducing so if they're not involved in LIHTC or renewables, then they're probably on it. I'm saying this and please send me emails, correcting me to my audience. But as a general matter, if you're in only a handful of the smaller credits, then you're less likely to be as sensitive to this issue.
And Mike, it's probably worth mentioning too, and we've talked about this before, if it is passed and adopted, it doesn't matter whether or not the U.S. adopts it.
Right.
Due to this top-up tax, essentially, where other countries can essentially collect that tax. And so there is still an issue if the U.S. does it.
Yeah, thank you for that. So, Dirk and Tony, what say you on the global minimum tax?
Yeah, no, Brad, that was a great overview. And I know you mentioned the method of accounting kind of being key to whether or not this might apply. I know I would say a majority of LIHTC investors are using equity method or portion amortization method, which is under equity method, and they're not consolidating their investments. So by not consolidating their loan housing tax credit investments, it looks like they would be scoped out the global minimum tax. So I know there was a lot of worry kind of when it first came out that it was going to impact the LIHTC community, but it seems like by not consolidating, most investors would be scoped out.
Tony.
Yeah, similar to Dirk, renewable energy investments are structured. The most common structure out there is the partnership flip transaction. And those tax equity investors almost always qualify for equity method accounting treatment. I'm not aware of any investor in the market that consolidates their investments in these types of partnership flip structures. So I think at the moment, these investors are feeling like they're feeling okay with respect to GMT.
I'll bring that to a close, but I'll just I'll give the caveat. There's the scope out question, but then there's also questions about how the calculations get done, which can have some unique impacts. We definitely had clients that is actually running the calculations. Issues pop up that you don't think about until you're actually running the numbers. And also that we're in a good place now, but the global minimum tax hasn't taken effect. And ultimately, it's a multi-year kind of process for it to take effect, get interpreted, for a country to make their assessments. So this is something that we can be in a good spot, but we have to stay very vigilant. And speaking of vigilance, one thing that we've been working at Novogradac for many, many years is proportional amortization of tax credit investing. And even to take a step back from that, way back in the day, before proportional amortization was allowable for monthly tax credits, we at Novogradac were very focused on trying to change the way in which tax credits were accounted for under generally accepted accounting principles. And the general sort of default was that tax credits would be claimed below the line, would be reducing your tax expense for a major corporation, but the actual deductions from your investment is above the line. So basically your pre-tax, if you made an investment in many tax credit investments, pre-tax, you were showing a loss, but because of the benefit that flowed through the tax provision, after tax, you showed positive income. And that mismatch would cause many public companies to say, why would I invest in something that creates a pre-tax loss even if it's a good investment because of the impacts on my tax provision. And the idea was to come up with a method of accounting where you don't have an above the line loss, below the line a tax provision gain, and you could move the loss down to the tax provision. And ultimately, we were asking for that for all credits. We ended up getting it initially for lumped tax credits. And then recently, that provision was expanded to all credits. And Brad, you really led the effort at Novogradac on this second pass through. So if you could once again briefly talk about where we ended up and what impact that's having on the equity markets for new markets and historics, and then have Tony weigh in on renewables and Dirk weigh in on any iterative effects on lump tax credits.
Sure. As you mentioned, this was kind of the cleanup that was of the work that was done like 10 years ago to create proportional amortization initially. And as you mentioned, at that point in time, there was a desire to have it applied to all tax credits, but unfortunately, it was only limited to the low-income housing tax credit. And so over time, that's all that who could use it. Since then, new credits are created, and as investors start to focus on different things, including expenses on their income statement, and now trying to re-engage and to find ways to move those expenses below the line. As you mentioned, there was an effort within the new market tax credit industry specifically to expand proportional amortization to new market tax credits and other tax credits. And so that through that process with the Financial Accounting Standards Board, FASB, they took on this project. They ultimately did expand it to all tax credits, which I think is important that they didn't name what those tax credits were, because as anyone who follows tax credits, there's the potential for new ones. And so the desire was for it to apply to current and future tax credits. For the new market tax credit, though, the impact has been minimal so far because of something that I mentioned for the global minimum tax using the equity method, that it would not apply to investments that consolidate. And so, and new market tax credits, the way that they're currently structured, most of those are consolidated. Most of those investments are consolidated. So unfortunately, proportional amortization is not available for those investments. And so where there was a hope that that would not be the case, since that language wasn't in the initial proportional amortization language, it has not had the impact on new markets that was originally anticipated. However, as we have seen, and unlike FASB doesn't want to necessarily admit that accounting rules do impact the way investments are done. We're starting to see new market tax credit investors consider different structures that will allow them to avoid consolidation, to be able to use proportional amortization. And this is not only for direct investment, but also investments in the secondary market. So I think that if the market is able to find structures that work and are widely accepted, this ultimately increases the investor pool, especially on the secondary market, because the secondary market is extremely interested in proportional amortization. They want that same kind of favorable treatment. So it's still to be seen if the market moves more in that direction and changing the structure of these new market tax credit investments. So overall, I would say for new markets and historics, the impact has been limited to some extent, but I think we're seeing more impacts, Tony, and the renewable energy markets.
Yeah, that's right. So, in renewable energy, if you're a tax equity investor making an equity method investment into a partnership transaction, prior to the FASB updating their expanding the proportional amortization method to other tax credit investments. Prior to that, investors had to, that accounted for their investments as equity method investors, had to apply what's called HLBV, hypothetical liquidation at book value, to their equity method investments which is a complicated area of GAAP guidance, highly interpretive. And so you can get a lot of different sort of views in terms of how to apply HLBV. And it was enough of it was sort of a difference maker for many investors. So you actually had investors that liked what they saw in the program, but would decide not to participate because of the complications related to HLBV. So when the FASB updated the rules around proportional amortization to expand that to the tax credits, that's actually led to a nice benefit to new investors in renewable energy. And so we actually have seen several actually new investors enter the clean energy space because they can now apply proportional amortization as opposed to having to apply HLBV. And proportional amortization is a pretty easy to understand area of accounting guidance, and it's also pretty easy to apply. So, it's low in complexity, and you also tend to get the geography in terms of where you account for your investment in the place that investors think makes the most sense, which is below the line. And so, so PAM has been kind of a nice little boost for some new investors in renewables.
Acronym check. PAM is proportional amortization.
Proportional amortization method.
Thank you. It's not PA, it's PAM.
That's right.
Dirk, thoughts on LIHTC?
Say welcome to the party. LIHTC's been using proportional amortization for a while now. I have heard some LIHTC investors saying, we would look at new market tax credits if, we could get proportional amortization to apply there. So, I think, some LIHTC investors could be looking at other credits. As far as the LIHTC markets, we've been using that for several years. And I think most investors are now using.
Great. Thank you, Dirk. Thank you for that, Tony and Brad. Now I want to move to one of my favorite topics, potential legislative tax changes. So it's possible that we could have a year-end tax extenders bill. If we do, it'll likely be modest. There's a lot of narratives around whether we'll have a year-end tax bill. I do think it's pretty much a given that there won't be a tax bill before the election in a couple months, but there's the potential for a tax bill during a lame duck session. And if there is such a tax bill, as I say, it would be modest and likely be based on the House bill that passed earlier this year that the Senate recently voted down due to the opposition of Senate Republicans. That said, when I think of tax legislation, as you all know and our audience knows, I'm very focused on 2025 and the expiration of many Trump era 2017 tax cuts and how Congress will deal with that. That means there's likely to be major legislation in 2025 or early 2026. And I say early 2026 just because, Congress could enact in a delayed basis. And even early 2026, it could be that, Congress lets things slide, through 2026 because some of the provisions expire at the end of 2025. And Congress has gotten used to dealing with expirations on a retroactive basis. That also being said, to the extent that W-2 withholding and all the rest would change in 2026 based on 2025 expirations, it's likely that Congress would want to get something done in time that voters' paychecks and the rest are already getting higher withholding and the rest. So long-winded way of saying major tax legislation, 2025, early 2026. There's also a history when a president is elected that they have a major tax bill in the first year. When we look at that, I didn't think to myself, okay, there's something potentially year end, and then there's going to be some type of tax bill in 2025 or early 2026. And then when I think about what's possible, I think, what are the election results going to be? And that'll provide the contours for within which something can happen. And I predict one of three things will happen. In no particular order, there'll either be divided government, the Republicans will sweep, or the Democrats will sweep. And when I say Republicans or Democrats will sweep, I mean they win the presidency, the Senate, and the House. So in those three scenarios where you have divided government, a Republican sweep or Democratic sweep, the contours for the legislation would change dramatically. Clearly, if there's divided government, there has to be bipartisan support for whatever gets done. And we've seen this happen before when George W. Bush's tax cuts expired under the Obama administration, and they had to address the expiration of the Bush era tax cuts, where roughly 98% of the tax cuts were extended. It was only the highest income families that didn't get the similar extensions. If we have a Democratic or Republican sweep, then every expectation is wherever is done would be on a partisan basis through budget reconciliation, which means that they would pass a bill that would be in effect for roughly 10 years, and they would expire again, just like the Trump era tax cuts are expiring. If you end up with divided government, then it's possible whatever changes are indefinite or only for a year or two as a way of kicking the can down the road because they can't get a broader agreement on other matters. So once again, either there's a sweep and it's a purely Republican or purely Democratic bill that's likely to be likely to be a roughly 10-year span, or there's divided government and it's likely to be really challenging to get a bill through, and the bill may not be quite as long dealing with the tax cost aspects of that. So with all of that as kind of background, I wanted to first ask each of you to discuss, the area of tax credits that you're focused on and what some of the possible direct effects are on your credits. And by direct, I mean how your provision itself might change. And then I'll come back with indirect questions. So Brad, if you could give an overview of what the key asks are for the new market tax credit, and then also the key asks for the historic tax credit, as best we understand them, knowing that these asks can evolve over time, and next year, the asks might be slightly different.
Yeah, and based upon your three scenarios, I guess it's a good thing that we haven't put all of our eggs in one of the two parties' baskets, right? Because none of the three scenarios does it seem like that would be a good place to be. And so it's fortunate that for new markets and historic, there is strong bipartisan support for them, as well as for other tax credits. For new market tax credits, obviously the piece of legislation that is most important to it is for the program to be made permanent or an indefinite part of the tax code. And that's important because it is set to expire at the end of 2025, which lines up very nicely with all of these other expirations. And so there is a permanency bill, as there has been for a long time now. But currently, the permanency bill in its current state obviously asks for permanency. It asks to maintain at $5 billion that would be adjusted annually for inflation, and also to remove the AMT limitation that currently exists. In addition to that, I think some important asks are the removal of the basis adjustment. We've talked about that a little bit in other responses as to why that doesn't put it at the same level as the low-income housing tax credit, for example, and how that would be an improvement to the value of the new market tax credit. I think one that maybe doesn't get enough discussion is the recapture nature of the new market tax credit and how changing that could also improve the value of it. And then, as you talked about in your testimony in front of the Senate Finance Committee, just other little aspects of it that would allow it to work more easily with other tax credits. I think when you look at those different provisions, those would probably have the greatest impact. Obviously, permanency. If permanency isn't achievable for whatever reason, I think that Plan B would be a long-term extension, like the most recent extension was a 5-year extension. Because as we've seen, the one thing that would greatly benefit the new market tax credit is consistency and predictability. We've gone through enough 1 year or 2 year extensions, and we much more would prefer permanency. But if that's not available, then a long term extension. There's a couple other bills related to new market tax credits that would also be beneficial, like the Rural Jobs Act and the Tribal Tax and Investment Reform Act, that could also be beneficial in terms of incentivizing and using more new market tax credit capital in rural areas as well as in tribal areas. So I think all three of those, would have a tremendous direct impact on the new market tax credit. Similarly, for historic tax credits, you have the HTC Go bill, which is the Historic Tax Credit Growth and Opportunity Act. And similar to the new market tax credit permanency bill, the proposal would eliminate the basis adjustment, making HTC easier to pair with other tax credits, especially low-income housing tax credit and new market tax credit. It would provide a 30% tax credit for small projects, allow them to be more financially feasible. And it would also redefine the substantial rehabilitation rule to 50% of adjusted basis rather than 100%. And then there's other, I guess, things that could be done to improve the value of the credit, returning it to a 1 year credit. As we talked about, it went from a 1 year credit to a 5 year credit, and that obviously created downward pressure on pricing. So returning it to a 1 year credit, I think, would obviously be beneficial. And there's also been proposals, now that we've seen the value of transferability with clean energy, to potentially incorporate some kind of transferability for smaller historic tax credits to allow them to become more financially feasible. It's one of these credits that really hasn't been modernized for a long time, since probably before 1986. So I think that it's time not only for historics to be modernized to go along with kind of the rehab theme of the historic tax credit, but also for new markets to be made permanent. So that's my stump speech for those two.
Thank you, Brad. Dirk, let's turn to low-income tax credits. And there's the Affordable Housing Credit Improvement Act, which has many, many provisions. It'll get reintroduced next year. Maybe you could discuss a couple of the highlights on the production side. Affordable Housing Credit Improvement Act, you expect to be the major push of those working with Congress on behalf of modernizing and enhancing and improving the low-income housing tax credit.
Sure. So I figured I would kind of focus on the supply side, since that's kind of the theme of what we've been talking about here. On the 4% side, the 4% low housing tax credit, increasing the supply would be mostly related to lowering the 50% test. The Affordable Housing Credit Improvement Act calls for it to be lowered to 25%. The most recent bill that you discussed that was passed in the Senate, that reduced it to 30%. 30% and 25% both would, help increase the supply in those states, are volume cap constrained, or may have issues between tax bond deals there. Also on the 4% side, we have the discretionary basis boost. The 9% credit has had the discretionary basis boost some years now, and the state agency can give that discretionary boost to a 9% finance property. The 4% tax credit does not have that discretionary boost. So that boost would also increase supply for those properties that are not in a qualified census tract or a difficult to develop area. And then lastly, on the 9% side, the Affordable Housing Credit Improvement Act calls for an increase in the 9% allocations. Many of you know that the 12% or 12.5% increase expired, and that has not been extended. The act would call for the extension of the 12.5%. In addition to that, there would also be a 50% increase that would be phased in over a 2 year period. So notable increases there on the 9% side. All three of those provisions, I think, would have a big impact on the supply of low carbon tax credits.
Great. Thank you for that, Dirk. And I would just also note for our audience, there is also the potential of enactment of a workforce housing tax credit, which is basically lofty tax credits for slightly higher income levels, as well as a neighborhood homes tax credit for building or renovating single family owner occupied homes in distressed communities, which obviously either those were enacted that would increase the supply of tax credits. And if you want to know more about either or both of those, please reach out to Dirk Wallace, because he takes the lead at Novogradac on those two potential new incentives that could get enacted next year. Tony, obviously the renewable energy community had a huge win with the Inflation Reduction Act through the expansion and extension of tax credits, clean energy tax credits for at least 10 years. When you think about potential tax changes, what do you hear there in the renewable energy community?
Right. That's right. So yeah, in August of 2022, the government passed the Inflation Reduction Act, which represents the country's largest investment in renewable energy ever. Okay. And so since then, there was such a significant tax law change that the industry's really just been kind of working with the IRS and Treasury to solicit more clarity on guidance under the IRA. And so as a result, you haven't seen any like new legislative efforts for renewable energy. It's really just about kind of making sure the industry really understands how to implement the provisions contained under the IRA. But in terms of legislative risks, the renewable energy industry stakeholders sort of they fear election outcomes. And if you get sort of the wrong election outcomes for the industry, there's the fear that some aspects of the Inflation Reduction Act might get sort of clawed back a bit. Okay, so there's that fear out there. So, obviously the major advocacy groups are lobbying hard to sort of preserve, what we've got right now for clean energy incentives under the IRA. Yep. And then in the industry is also sort of bracing themselves or preparing themselves, I should say, for the technology neutral credits. So at the end of this year, the credits under Section 45 and 48 expire. And so for facilities that place in service after 2024, they would need to meet the criteria contained under Sections 45 Cap Y and 48 Cap E, which are the technology neutral credit provisions. So
thank you for that, Tony. And for the audience, I just note that as one thinks about the Trump era sort of tax cuts and the dynamics that will be at play and who wins control of Congress, or if there's a divided government, is so critical. If you were just to say the Trump tax cuts get extended kind of as is, and no one expects that to happen, but just as a benchmark, the range of costs are $4.5 to $5 trillion over 10 years. And that $4.5 to $5 trillion, I think I think every member of Congress would say, given the level of the national debt, that level of increase over the next 10 years isn't something that they want to be voting for. So the question becomes, what provisions don't get extended to bring the cost down? And or where do taxes increase, such as raise the corporate tax rate to raise revenue? It was 35 down to 21. The Biden administration and now Kamala Harris is supportive of a 28% corporate tax rate. Some Republicans have talked about a 25% rate. So one way of kind of bringing things into balance is raising the corporate tax rate. Another way is to try to repeal certain tax provisions. And that's one of the concerns in the renewable space is, if Congress were to repeal some provisions that are out through 10 years, even if they just repealed it, 8 years, 8, 9, and 10 or something, that could generate revenues to bring down the 10-year cost, as well as just changing the way a variety of other provisions work in the tax code that are ways to enhance revenue, even if it's by reducing a tax expenditure. So basically everything's on the tables. or said differently, everything is on the menu. And folks are going to want to be at the table so they get the selections that they're most supportive of. But when I think of the sort of broader, I mentioned direct changes. I appreciate all of you talking about sort of the direct changes on the various tax incentives. When I think of indirect effects, I can't help but think of the corporate tax rate and the impact a higher corporate tax rate would have. I think Trump's talked about taking it to 20. He might have even said 15 at some speech. But if you assume for the moment the corporate tax rate, if it's altered, likely would go up somewhat. And then there's also expensing of property, and expensing of property, personal property and land improvements was something that is in the process of phasing out. And then there also was the limitation on interest expense deductions. And those are the three that it seems within the field in we work had the most potential impact. So maybe, Dirk, I'll start with you in terms of those three provisions and the impact on monthly tax credits. And then I'll move around the horn and let Brad talk about new markets and historics, and then Tony on renewables on those three items. And then we'll kind of come back to other items that within the committees you're working on that are getting the most attention in an indirect way. Dirk?
So when I look at a tax credits transaction, and you're looking at the benefits, you're looking at credits, you're looking at tax losses. $1 of credit is always going to be worth $1 of credit. So really the variable here is how much is that $1 of losses worth, and over the 15-year investment period, when am I going to receive that $1? Am I going to receive it today, or am I going to receive it in year 15? So when I look at the corporate tax rate, it went from 35 down to 21%. That $1 of losses went from 35 cents down to 21 cents. So increasing the corporate tax rate would increase that value of $1 of losses for corporate investors. So that should increase, a return, or could put upward pressure on pricing, keeping returns constant. Looking at, expensing, we've been kind of going through this roller coaster with 100% expensing, with the phase out, as it's been phasing out 20% a year, bringing that back up to 100% expensing for, in a LIHTC transaction, be 5 and 15-year property, our personal property, and our site improvements. Those are common classifications of assets. Those would be expensed upon place in service. 100% expensing were to be enacted, and that would greatly increase the amount of losses that would be received in place in service versus over a 15-year period or over a 5-year period. So again, I think that would create some upward pressure on pricing. And then the last item with the business expense limitation, like rental real estate properties, can elect out of it, but it does increase the depreciable life of that of the building from 27.5 years to 30 years. And again, I may not seem significant, but when you're looking at 15-year stream of benefits, every little bit can help that returns. That would also have a positive impact on a LIHTC investment.
Great. Thank you, Dirk. Brad, new markets.
For new markets and historics, I think it's really comes down to the question of whether or not they also remove the basis limitation for either of them. I think that, that's really where, any of these three would have the greatest impact in terms of, increase in the tax rate, expensing, and so forth. I think for the way that, these types of investments are structured, if nothing else changes but the tax rate, it's going to be a minimal change, just like it was when it was lowered. So I think that we can look at kind of these things for new markets and historics, but they don't have as much of an impact because of the types of losses that are flowing to them aren't similar to the log of housing tax credit.
Okay.
So really it's, are we talking about with or without a basis limitation?
So Tony, talk to me about the effect of the corporate tax rate, the effect of expensing personal property, and interest expense limitations on the renewable energy space.
Sure. So, when the corporate tax rate went from 35 to 21%, that had an impact on tax equity pricing. So the value of the tax losses went down. Well, first of all, corporations are paying less in taxes anyway because their corporate tax rate goes down. So the amount of tax credits they need is lower. So that impacts pricing. And then the value of the tax losses also goes down because you're getting a 21% benefit as opposed to a 35% benefit. And so I would expect if the corporate tax rate went back up that you would see an uptick in pricing, just like you saw a downtick in pricing when the rates went down. Okay. So probably a favorable impact on tax equity pricing for developers if the rates go up. As far as bonus depreciation goes, that's not you don't see bonus depreciation on the majority of renewable energy deals based on the way capital accounts have to be maintained in order to preserve tax loss allocations, et cetera. You usually see folks go for regular makers depreciation or even opt into sort of 12-year ADS lives for those types of assets to preserve capital accounts. But anyway, bonus depreciation, there are enough deal participants in the marketplace that do value bonus depreciation where I think overall the industry would sort of welcome having bonus depreciation getting, reinstated back at that 100% level. All right. So I think it would be a little bit of a positive difference maker there. As far as the interest expense limitations go in renewable energy, usually those aren't as levered as you like to see in real estate deals. So like real estate deals, you can see those partnerships really heavily levered. 70, 80% of the financing can come from debt in real estate, whereas in renewable energy, you're talking like 50% or less. And then even when you have debt in renewable energy, oftentimes the debt is brought in behind the tax partnership. The general partner or the managing member, the sponsor of the tax equity partnership is borrowing the debt and then using the borrowed funds and contributing the borrowed proceeds down to the tax equity partnership in the form of equity. So you're not really getting that interest expense benefit usually at the tax equity partnership for renewables. You do sometimes see project level debt in renewables, but more often than not, the debt's kind of back levered to the sponsor. So less of an issue, I would say, in renewables with respect to interest expense limitations.
Right. Thank you for that, Tony. That was really helpful. So now, as promised, we're bringing this to a close, but I'll give each of you a chance to discuss if there's some other major tax law change or minor tax law change that your various communities are looking at and thinking it would be beneficial or detrimental to see. And whoever is interested in tossing something out there first, please jump in.
Yeah, I know in the loan causing tax credit industry, I mean, it's often, paired with other credits. So I know, a lot of LIHTC developers, are looking at the historic credits saying, well, it'd be really nice not to have that basis reduction. So I think it's not just isolated to one credit. I think we mentioned before, there's a lot of overlap between the credits and, LIHTC does pair with other credits, often in transactions. So I would just say, in the LIHTC industry, we definitely keep an eye on other credits.
In renewable energy, the wish list, I would say, is those renewable stakeholders would love their investments to qualify for CRA. I think that's a long shot at best. They also would love to see the passive activity rules and the at-risk rules to go away for individual and closely held investors into renewables. Again, another real long shot in my personal opinion. And then, and so those are the two biggest items. And I would say those are the two areas where if the industry could get their wish, they could get those modifications.
Definitely like the sensitivity rules for individuals, particularly for renewables and transferable credits. Brad?
Well, I think for new markets, come talk to me after we get permanence.
You're singular. I
mean, that is, yes, the most important aspect of it. What's smart about all of this is we can talk about all of it in a vacuum, but as we know, no tax legislation happens in a vacuum. There isn't one lever that's pulled, right?
Right.
And I think what, we can have all these wishes for things that we hope to improve it, but I think we can also create just as long of a list of things that we hope don't happen to the credits by, other levers being pulled. So I think it's just as important to kind of look at it more broadly too, just because so many different aspects of legislation that can ultimately impact our credits.
Thank you for that. Go ahead, Tony.
Yeah, I forgot to mention the Basel III correction. So renewable, that industry would love to get that sort of 400% capital weighting reduced down to 100% or lower.
Great. Thank you for that. And I'll use my host sort of prerogative to also mention opportunity zones. This two-part podcast series is about tax credit equity pricing. So we haven't really talked about opportunity zones, but I do think the legislation next year provides a great opportunity to create an extension for 2 years of the current opportunity zones designations to make up for the time lost due to the regulations delay along with the COVID delays. And then to also have reporting be mandated beyond what you have to report as part of your tax return to demonstrate eligibility. And then the third item is to have authorize a new round of opportunity zone designations and other enhancement and improvements to opportunity zones. And then I'd also throw in the Neighborhood Investment Act, which you talked about earlier in terms of single family tax credits allocated, develop and renovate single family homes in distressed communities and the work for housing tax credit. And I do think there's also room for a number of other, new incentives that are modest, part of a larger tax bill.
Mike, I think we need to create a betting website on all of these provisions and what people think is most likely to happen, similar to the outcomes of elections, and see where the market's willing to put their money.
Very good, Brad. I'll let you run that by our general counsel.
Sure, of course.
Us creating a wagering website.
That was a great idea. Thank you.
We'll see what she has to say about it.
Yeah, exactly.
Any of you have anything else you wanted to share before I bring this to a close? Very good. So let me say thanks to each of you again for being on the podcast. This is really a great 2-part series. I think the audience really appreciate all of your insights, and it really kind of sets the stage for the next 18 months. And as I noted earlier, I will include the contact information for Brad Elphick, Dirk Wallace, and Tony Grappone in today's show notes. Once again, if you have questions on low-income tax credits, please reach out to Dirk on historic tax credits or new market tax credits. Reach out to Brad, and anything renewable energy or clean energy related, reach out to Tony. And as I do every week, I do want to remind our listeners, please subscribe to our podcast. I remind our viewers to subscribe as well. And do please share the podcast with your colleagues. Feel free to tweet out or post something on LinkedIn of this particular episode that you enjoyed watching or listening. Thank you once again, Brad, Dirk, and Tony. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.